This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Katie Engel, a trend-following trader with experience going back to the 1970s up to today. A wide cross-section of wisdom Katie brings to the table. I hope you enjoy this conversation. Explain to me, though, your father and just briefly his business.
He felt like if the best way to solve a problem in a business meeting was just take off your jacket. Let's go. And so he had this kind of instinctive, very kind of old school John Wayne, approach to dealing with people. He went into the war, became a fighter pilot, flew P-51s in northern Italy. Loved that. He came out and by then had started finding oil on his own. And so it was pretty much, he believed that he used to remind people, I feel like a wolf in a world full of sheep. And so he was very aggressive and very hell-bent to do whatever he wanted to do. No one was going to tell him what to do. Was very successful in the oil and gas business. He then had drilled up leased up a 120 square mile gas field and discovered a gas field with helium in it. No one would buy his natural gas, because it was too low in BTU. So he said, well, what can I sell the helium, And there was a helium market. We sold helium in Voyager and Pioneer space probes. They use it for insulation. There's angled helium in those. And we sold it to NASA. They insulate it with the nuclear submarines. And so he went to Chase Manhattan Bank, borrowed $7 million. I went back there with him from Kansas, where he was from, and met David Rockefeller when he signed his loan agreement, and was quite young. And then built this plant and sold all this helium, and then eventually sold that helium plant. He took the proceeds and bought a 2,000 contract position in gold at $212 in 1978, having never traded any market ever before, but he believed that the gold had plenty of room on the upside to go up.
Okay, so the proceeds from the sale, roughly $2 million?
$2 million is what he had.
So now he's taking the $2 million and putting that into leveraged gold positions.
He had 2,000 contracts of gold in both New York. At the time, they were in both New York and Chicago markets, going out about a year and a half in both markets.
But at this moment in time, your father is a pure speculator working on, of course, he's got life experience to know he wants to take this position. But from any kind of statistical measure, he's kind of going all in, and there's no diversification, and it's like I'm betting a life's career on this trade.
Now, he had 300 oil and gas. This was not like here's the thing: if he had lost the $2 million, he had 300 producing oil and gas wells that he owned himself. He had 10 drilling rigs. He had a business.
Okay, so this was small. This is a small percentage for him then.
In terms of his liquid net worth, in the way the oil business works, that during those years with debt and borrowing and all of that, he was basically, you're rolling over debt all the time, so you're constantly maintaining a fairly large debt balance on your balance sheet. But it's not like, this was a big deal because it was a total departure of anything. He got Michael, he got called regularly from stockbrokers to go in the stock market. He says, I don't know anything about that, and I don't have time to learn. That was his standard answer, and then he would hang up on him.
What did he tell you, that he was going to put $2 million into gold and take this massive position?
Well, that's an interesting thing, because at the time that he did this, he had borrowed some money from the local bank, and we were pretty good shape. Things were good, and he didn't really tell me that he did it before he was going to go do this. And so I found out about it about 60, 90 days into it, that I'd never heard the word futures before in my life. So he just did it on his own because he thought it was a smart thing to do. But he believed that if anything, and I've read this about like Soros too, that if it's worth doing, it's worth doing big in the markets, which is not the way I manage money. But you have to understand, and your listeners should understand, that this was my introduction to the markets, meaning that the gunslinger approach that people refer to as my father, really what the benefits I got from that was I grew up in a risk-taking, I would say a calculated risk-taking culture, and living with a man like this, what it does breed in the guy that is coming up behind him. Because, I was in the airplane when he landed, his airplane, when he landed and it stalled on the runway with a 747 coming in behind us, and he couldn't get it off the runway. Why? Because it wasn't being adequately maintained. I told him I'd never fly with him again. Meaning that some of this stuff carried over in the personal life. So what it does as a child, you go, I want to be extra smart about what I do. I don't want to be cavalier. I want the other direction in terms of making decisions, personal decisions about my life, professional decisions about the way I conducted business. So it doesn't make you more like him. It makes you kind of go in the other direction.
Let me add something to that end of that story before we move on. So he took a $2 million position in gold and in 6 months turned that into $100 million?
His position on January, he kept a yellow legal pad, and I had not. And on the third month, to back up, he was up to about $3 million profit over his $2 million. And the president or the vice president of the brokerage firm flew down to talk him into taking his profit because they felt like, because he was so new, that he was a greater threat to their solvency than anything else. So it's like when a casino comes in, or when you go into a casino, and I don't know because I don't go into casinos, but when you read about when the big fish comes in and starts winning, the casino gets nervous.
The whale.
There you go. Exactly, Michael. And so he told him, look, he bitched him out for about an hour and a half and said, get back on your plane. Gold was around 300 at the time. Gold's going to go to $1,000. Don't tell me how to run my business. Get out of here. And he did. But in 3 months later, his open and closed profit, meaning that what he had closed out, open positions he had, because he had a lot of open positions still on, was just a little over $100 million.
What was the net result? Did he eventually take a lot of it off the table? Did he walk away with the profit? He did was he was still selling I think it was January 20th of 80, that the price of gold was peaking in the mid to high 800s. He was taking profit still on that day. He ended up closing out about $65 million. And what he did with that was he bought the fourth and the sixth largest bank in the state of Kansas for cash. He bought, and with that came a 122 room luxury hotel, and paid all his debts. He was he was debt free for the first time in his life, and he was diversified. And he became more of a community pillar type of person because of these bank ownerships. Because in a lot of cities, relatively, I would say small cities, banks play a very kind of a community role, and so the locals have a big local presence. So he was all of a sudden came kind of from this obscure oil and gas guy to a, kind of a more known person there in the city. So is he with us today still?
No, he passed away about 5 years ago, but he that was his first trade. He had plenty of money to borrow against. Now he had plenty of assets to borrow against. Now his second trade he lost $20 million, and his third trade he lost another $20 million, and then he really stopped trading the futures markets. He eventually sold his banks, had some more cash, and then ended up going in the stock market because it was a lot easier to manage, and he didn't have to sell positions. And his timing tool on his first futures trade was really just back then, if you held the trade for more than 6 months, you went from a short-term capital gain to a long-term capital gain rate. So he had a better rate after that. Was his sole timing, just hold on to it for 6 months.
Well, I'm sure the audience, just like myself, was realizing as you said those 2 losses, because I was curious if he was no longer with us. I was curious if he had left the planet with all of his gains. But as you talked about those 2 losses, now I'm starting to see, okay, here's where your influence is really coming into play, because you're seeing the up and you're seeing the down, and you're saying, I don't like, this doesn't seem the best way to do it, I'm guessing.
By the time he had lost that money, I was trading on my own and understood that he was not the personality type that I certainly wanted to carry over. I didn't want to carry his personality type into my work with the markets. The reason I got really interested in the markets was not so much that he had made $100 million. It was because as I was in the oil and gas business, I grew up in it, and here's the newsflash: the oil and gas in those wells runs out eventually. So I felt like it made a lot more sense if I get into a business that I could kind of generate through strategy and mathematical formula, generate profitability in a moving market. I could do that perpetually as long as it's moving. So that was my core. That's the core lesson I came away from. And by growing up in that culture, I kind of had permission to do that. No one gave me permission. I just was, there was nothing to prevent me in my own head to prevent me from going out and learning how to do that.
Look, you and I both know there's one of the biggest influences of many people that trade trend following type systems was Richard Donchia. But early on, after you're away doing your own thing, was there an early on trading influence for you beyond looking at your father's career?
I learned about a lot of these people after I was already kind of had established some success. And the short answer to that is no, I don't have any influences at all. I learned this completely on my own. The more I did it, the more I realized I needed to up the ante on how to do research. My first computerized program that I built was on an Apple IIe in 1985. So I knew that if the strategy was, my dad was a fighter pilot. He liked to be out on the front lines when he would, and we need those people to win the wars. These are very aggressive. If everybody wants to go home and I still have some gas and bullets, I'm going to go out on my own and until I run out of bullets. But then there are those guys, the logistic planners. This is what we're going to do. I am much more of that ilk, to where I want to see it all on paper. I want to design something so well to where when we embark on this idea, it's going to have a high probability of succeeding. So my approach, the whole systematic approach, I felt very comfortable with that very early.
When did you first start putting, I want to say 1985, but is that when you first started to, you mentioned the Apple, was that when you first started to put rules together and start to say, okay, I want to test XYZ and I want to start to back test, so to speak, your ideas and strategies? Well,
the back testing part was harder, but I put together a strategy that became a part of I read all these newsletters that my dad bought during this gold era, and I thought, these guys aren't that smart. And so I thought it was a great offshoot to easily kind of get into a different line of work. So I created a strategy that was the backbone of a newsletter where the early books, you asked about the early influences, all the books that I read about technical trading and the markets, most of those books at that time that came out of the 60s and 70s that I got my hands on were futures market books. I recently spoke as a keynote for the Market Technicians Association, and most of those guys are stock people, and I was just surprised because they said, we haven't had any futures guys for quite a while. And I said, well, in my view, the technical approach to trading with rules in markets got its start in the early years of the futures industry. So that's where I was, and most of the books that you found, and because of my dad's experience with the futures markets, that all kind of generated the information I had to work with was all futures based. And then I liked the long-term trend following idea because in the newsletter that I was doing, I was doing it part-time. I was still working for my father's company and trying to figure out, to build my life. And so I was using weekly charts to make recommendations on. And so the big lesson in the whole newsletter experience, and I did it for 10 years, was that you could still give people correct information in which to act on in the market, but only about less than 15% of them will get the results that they should have, because the other 85% are either not disciplined to do it or they're fading the recommendation. The majority of the people cannot follow the recommended strategy, even if it's producing in the markets, even though it's good. So that every year I would lose 85% of my subscribers, even though I would be ranked well or among the top or among the top over that 10-year period. So that's when I realized I needed to get in the discipline business, and if that meant asset management, and then if that means asset management, now I'm competing to get some very well-financed companies, very smart guys, computer guys, quant guys, math guys, to where I better get my whole approach to research, take it up to a whole new level, so I can compete and stay in business over time.
I want to jump into a really interesting meeting that you had in the mid-1990s, because there's some commonality, as I expressed to you in email. But I want to bring something up. You talked about the MTA, and I think it's a major source of confusion. I spoke for the MTA at a keynote, I think it was in 2012 in New York City, and I asked for a show of hands in advance for those that understood kind of this technical trading from a trend-following approach. And I'm telling you, I have a room of about 600 people, and I'm not talking bad about the MTA folks, because I just spoke for the MTA in Singapore in February, but the show of hands is about 10%. So it's really interesting to me that so many people that want to be involved in technical trading are a part of the MTA, seemingly have no understanding of the existence of a guy like you or Bill Dunn or David Harding, and the list could go on, Larry Hite, Ed Secoda. They seemingly don't have any connection. They're in this entirely different parallel world that doesn't include the trading that we're about to talk about.
Well, it's a matter, I think, of culture. And I when I was asked to go speak, I wanted to kind of get a sense of what their priorities were, but in the future, in the futures world, in the asset management world that use futures, it's just a really big part of how you do the business. And when it comes to technical people in the stock and bond world, and mostly the stock world, I would ask these guys, what's your process? How do you decide to put on a trade? The bottom line with that crowd, with that particular group is that a lot of those guys work in firms to where they don't make the trading decisions. Ultimately, it's done with a portfolio manager, PM. So they're trying to convince other people that what they do is worth listening to. In all cases that I spoke to, and I didn't have a lot of time to conduct little individual interviews, but in all cases, the technical aspect was it was kind of like the salt and pepper to what was already a fermented trading idea, meaning that it was already baked and done, and now they're going to add their information, but no one is really putting together a fully comprehensive A to Z, soup to nuts, everything you're going to do in the thought process strategy that has been thoroughly tested in a way, and the testing process is something that's an art as well. Not everybody knows how to do that well. So, but it basically, the idea of sitting down and doing that just sounds like, I'm sure at some level in these firms, it's just a big pain in the butt. And the thing that I learned as far as when talking about the difference between people in futures and stocks, I'm always curious how you lose a program or how you lose clients. So I was talking to a friend of mine who manages about $1 billion in stocks, and I said, "How do you lose a client?" And he goes, "What do you mean?" I said, "Well, when you lose an account, what's the typical price? Why do you lose an account?" And he goes, "Oh, that's easy." I said, "Because he thinks I've forgotten about him." I said, "What?" He goes, yeah, like I didn't go to his kid's wedding, or I didn't send him, a Christmas card to his family or a birthday card. I said, you're kidding. You forgot about me, kind of like my insurance guy? And he goes, well, kind of. And I said, you mean it's not based on performance? He goes, not mostly. Not on the most part. So I think the standard for futures is much higher, or at least much different, meaning that I would love to be in a business where all I had to do is call the guy regularly and he'd never leave. But that's not the way it works in my business.
I think your salt and pepper line was spot on, because you're right. They've got the cake baked, and they know there's something else interesting out there, and that it's like, okay, we're just going to put some other stuff on here, but it's not, as you say, it's not A to Z. It's a piece. It's an angle. It's a slice. It's not. And why don't we just jump straight into that, because you had a very fortuitous meeting, and I believe it was in 1996. And when you said the president of Dunn, I can actually think of. So there'd be the chairman of the president. There was, at the time, there was two guys. I'll let you say the name. It could have been one of two guys that I would have known, either Bill Dunn or Pierre. I don't know. Who did you meet in 1996 in Geneva from Dunn Capital?
Well, you have to understand that you go to these conferences, they're expensive. I was a small company looking for more money. I had retail managed futures, which I wanted to get out of. I just wanted deeper pocket, more sophisticated money. So you go to these conferences and hope that you're going to meet some people, and you usually come back with a suitcase full of business cards, and not much ever comes from it. But I went to this conference in 96 in Geneva, Switzerland, and was the last night I think we were there, and where I had my clearing business, the president of that brokerage firm saw me. And he said, hey, Engel, we're having a dinner with some other CTAs. I need somebody. I need one more guy to fill my table out. Do you want to go? And I kind of like, well, what am I going to really get out of that other than a meal? And, to sit down with my competitors, because competitors are, everybody's tight-lipped and worried about revealing anything. He could tell I really didn't care. And he goes, it's supposed to be one of the best places, and it's very expensive. I think you'll enjoy it. I said, okay, I'll go. So, and I use that as an example, not because it's about a dinner, but people need to, life's a contact sport, and life has a way of showing up when you're not looking for it, and so that was a very spontaneous decision that I didn't necessarily have to make, and I think we should always be on the lookout, whatever we do personally or professionally, that something around the corner that you never expected, just be aware of that. Just be aware that it might come into your life, and if it doesn't, it doesn't. But that, to me, it taught me a lesson you never know, and unless you go, the opportunity never really can develop. But so we went to the restaurant, and I just thought to myself, I want to sit with the oldest guy I can find. And most everybody was, mid-years and stuff, but Pierre was a little older, a lot older than me, but I had never heard of Dunn Capital prior to that. I mean, maybe I'd heard of them. I think I might have seen Bill do a lecture or a talk at a conference maybe a year or two earlier, but I didn't really connect the dots, and, you're just worried about your own little thing, and so I sat down with him, and it was just by chance, and we had a great 4-hour meal there. It was I talked to the president of that firm the other day, and he still remembered it as one of the best meals or experiences that he'd ever had at a dinner table. So I was lucky enough to sit next to Pierre, and we talked throughout the dinner, and I asked him how much they managed, because that's kind of the first stupid question you ask, because it gets the ball rolling.
A lot.
Well, it doesn't really matter what you manage. Is really what matters is how much money do you make, But
a lot.
Yeah.
They were making a lot. They just make almost 100% for 1995, right?
Oh, if you go back and look at their earlier numbers, the industry really. That's why I don't go around promoting Dunn Capital, but since I have a working relationship with them. And a lot of people know about their story. But what I was surprised in my own story and getting familiar with them, which anybody could if they really wanted to, is that I asked him, how much money do you manage? He said, well, we manage about $1.3 billion or $2 billion. And at that time, that was a big number, a huge number for managers. And I said, how did you raise that much money? And he says, well, we didn't. We traded it up over about 15 years from 5 million. The answer didn't, honestly, it was such a different answer. It didn't, at the moment, didn't really connect with me at all.
Bill Dunn, in my humble opinion, after looking at every different type of trader track record, his longevity and the way that he has played with the juice that he has played for as long as he has played is one of the great American trading success stories. It's just a hell of a story. You could teach a semester, a year-long class, and just simply put the performance track records of Bill Dunn's operation on the wall and say, let's talk about it.
I know you're a big fan of trend following, and no doubt Bill Dunn is a pioneer in that industry, in that whole style of using the futures markets. I think that in the lesson I come away from what happened there in those, during his career is really comes down to compounding. And I have a small chapter on compounding in this book, not to pitch the book, but I think the real lesson here is that, everybody knows about Warren Buffett's compounding. But I don't know Warren Buffett. I just know about him and what people write about him. And I know that he had saved, by the time he was 21, he had saved $9,300. And that's in early 1950 something dollars. He was a big saver. And he knew that if he could get his hand on some money, he could do something with it in the markets by compounding. That's been his strength, but I don't know him. I mean, I know about him, but I do know Bill, and we're professional colleagues. I have worked with their company in a way that gives their company diversification, but we're not big social. We're not skiing on weekends or anything like that. This is a business relationship that's based on performance, probably more than anything else. But what Bill has done, and I think if you go back and look at some of those early 1990 years, when you look at some triple digit returns back to back over 2 or 3 years, no matter how much money you're managing, at the end of that run, you've got a big number. And the real strength in doing that is not robbing from yourself. When my dad was up to $3 million, there were people every day telling him to take the money and run. And so it's one thing to be good at dealing with adversity. When the wolf's at the door, the task at hand is very direct and specific. But to me, what's another interesting side of the coin is what people do with their prosperity. When somebody does something unique with their prosperity, then you have the possibility of doing something what a Warren Buffett has done or what a Bill Dunn has accomplished. And that's just believing in what you created, believe through the adversity, believe in the research. Don't heavily rob. You can still enjoy life, but you don't have to heavily rob from yourself. I mean, a $5,000 Corvette, when Warren Buffett was 30 years old, a Corvette cost about $5,000 fully loaded. If he'd have taken that out and spent it on himself, that would have cost him, I'm just around, I think, $13 million over time. So, being able to go with the project and because when you have critical mass, and then when you get even more critical mass, a 10% return on several $100 million or several $1 billion is so much bigger than a 10% return on 50,000. And that's what makes them unique, that but very few people are capable of not robbing from themselves, and they get distracted with, the relationships and, honey, can we buy this fifth house and we need more vacation. You buy stuff. And there's nothing wrong with buying things, just so long as the priority is your compounding project. Or you can wake up with a significant amount of money, and I don't think enough people really understand how that's possible. You do have to have a program or an investment strategy, product, whatever you want to call it, that's capable of performing over time. And that's really the great thing of you get into the product structure of futures. Is that, bull market, bear market. Now we have, at the time that I think they were up to $1 billion, I asked him how many markets did they trade. And he says, well, at this point, we can only trade 8 markets. That's how 8 markets was all they were down to, and they were looking for ways to diversify themselves by using other strategies that are created by third parties like myself, to where then we could co-research, we could better understand them. They could help seed those products. I would still own the product. I could go out and market it. And at the same time, they could have some capital, add a or a low correlated capital capacity to their existing business. And that's kind of what they were doing. It wasn't just with me. They were, when I came back from that trip, I opened up a Futures magazine about 3 weeks later. And there was a big article about how Pierre Tullier, the president of Dunn, was looking for third-party product. So, and I was with him for 4 hours and he never brought it up. So I generally didn't read industry magazines. I was busy doing other stuff. I happened to read the magazine. Then I happened to call him. I said, do you want to look at this? We've never traded this product, but we've got it developed. Would you be interested? They looked at it, and we eventually signed what we would term a strategic alliance agreement of some kind to kind of incorporate these ideas that had been developed under a kind of a joint umbrella where we could develop them and then implement them and hopefully make some money from them.
You know, you mentioned something at the beginning of our conversation. You talked about freedom, maybe paraphrasing a little bit. You talked about freedom of location. And there was a couple places that I visited early on in the 90s where I really got the inspiration for the freedom of location, and seeing Dunn Capital's offices in Stuart, Florida for the first time in 1996. That was an eye opener of like, oh, okay, you can be anywhere.
True. And the problem with New York City, and I like New York for certain things, but those people that think that the whole world revolves around New York need to travel a little more, because believe me, there are a lot cooler cities than New York City. But the financial community is, and I was, having been there just a couple of weeks ago, there's a lot of people doing very interesting things that don't live in the financial capitals, that we think of. So, the thing about, one of the things that I've been writing about and thinking a lot about because I don't think a lot of people understand our business. There's a lot of confusion about it. There's a big movement about what I would call risk aversion against volatility and the performance numbers that people produce. The thing about long-term performance is that if you're going to be committed to the long term and hold positions in the market that are more than a few days or a few weeks, you're going to acquire higher volatility numbers. So when you look at, I think volatility by and large is about as understood in our business as gravity is in the physics industry, work of physics and understanding how the whole gravity works and where it comes from. I think I see volatility as the fuel that makes markets move, which ultimately you can take advantage of. Where people want, in this low interest rate environment that we have now, people are deathly afraid of any kind of market movement. You've got managers that are building asset management business models on the premise that I'm going to generate returns that have very little volatility in them, so then I can attract bigger and bigger money. And then instead of leaning on the incentive side as much, I'm really leaning more on the management fee side of my business. So I'm not, I understand those asset managers that want to accumulate, $5, $10, $15 billion and staff, with 400 or 500 people. But that's not a business that interests me. I got in this business to make money from the markets, and so by being a little smaller, you can use more markets in your portfolio. The agricultural markets are in there. It's just as well as the stock index and the bond markets that have been dominating the larger return, or the returns from the larger managers over the last 7 or 8 years.
Just as we wind down, I want to ask a couple trading questions or get into a couple more issues. Your firm is 100% systematic, right? Rules-based, 100% rules-based. Talk about the notion of the rules-based, the systematic, But also, sometimes I see people and they want to, I used to see it much more. It used to be probably when I would see disclosure documents in the 90s, the early 2000s, I would see managers and traders often saying they still had a certain discretionary component. I've seen that swing now, though, to where a lot more managers are saying we are 100% systematic. Talk about the 100% systematic, and talk about the idea of adding discretion to a systematic approach.
One of the things that I think has helped promote a longevity in my relationship with working in research with Dunn is that in many ways we approach it from the same perspective. I think that people believe that it's okay to have the human element involved with the trading process. The problem with that notion, it's kind of like having a pilot there in the seat when today's plane can be completely flown by computer. I would say after takeoff, you can set that plane up now to where you can take it all the way to landing without touching anything. And everybody thinks that's a good thing. I think that's a good thing because I want the pilot there due to system failure. The problem with that premise when you bring it over into the markets is people want to feel like they can be involved today because you have all this information coming in. Oh, we've got an event that so-and-so, is going to announce tomorrow, or that they're no longer going to use palladium or platinum in the catalytic converters. Oh, that's a big piece of news. That's just one. But every day there's news. We have so much news we can't even process it all. So in the information age, which I've been hearing since I was in college, that it was coming, and boy, it's here, is learning how to filter out most of what you don't need. And this is the problem you get into when you add a little bit of discretion, is that if you have done everything you can do to statistically determine what is the best course of action from every step of the way in designing a fully developed investment product, and now you're going to leave that you're going to give that product the ability for someone to add 5% of discretion. Like I asked the audience at the MTA, how many people believe that a little bit of discretion is okay? And almost everybody raised their hand. The problem with that is that when you've done all this testing, and we do a lot of testing, I mean, to the point to where you can you can never stop. It's just like a painting that never stops being painted on. But if you really are doing that whole thing right, then you really want to rely on those courses of actions that the research is telling you on the day-to-day implementation of that product. But the minute you do one thing, 1% or less of discretion, you are now doing something that's never been tested before. It hasn't been researched. It hasn't been tested. It doesn't make it a bad decision, but now you've just thrown the years that it's taken to develop that research product right out the window. Because what you do to override this trade is now going to affect the continuity of the trades to follow. You have no idea now what you're doing. So to put the work in thoroughly before you start, most people don't even know how to start. That just takes time. You got to have some sort of sense about what the work is. But it's not trust me, it's not an optimization button. That's not it. And people don't want to work and understand what really their strategy is doing because they just want to have the computer do all the work, and they just want to come out the other end and start trading it because they've done what they think is the appropriate way to do this. And so if anything I've learned about research, and I am when somebody asks me, what do I do for a living? I said, I design rules-based strategies for use with computers in the futures markets. That's my core expertise. That's all I've done for about 25 years. And so you get a real sense as to what is good work and what is not so good work. But you do discretion, and it's interesting people want to go back to discretion because people assume that, you're going to trade yourself right off the cliff if you can't override it. Well, I think that's a pretty good conclusion if you haven't really done all your homework. Some of the big CTAs that blew up in the 80s and 90s, if you ask the people that raised money for them, why did they blow up? They typically will say that the most common answer is that they started going into a drawdown and then they peaked their previous worst case drawdown. They started to panic. Clients started to pull out or whine at the very minimum. And then, like an airplane in flight, they pulled out their toolbox and climbed out of the wing at 30,000 feet and started to try to quote unquote fix the airplane. And then the more that they tweaked it and fixed it, and I use that word loosely, things just got worse because now they're trading something the conclusion is, if they'd have just kept doing what they had been doing that got them there, they would have been okay.
It's crazy how it happens, isn't it?
It really is. And I've seen some traders lose a whole lot of money and just say, you call them and say, well, what do you think? You say, well, I think I just need to follow the plan. And then 3 years later, they're at new highs. Or a year later, or 2 months later.
Yeah.
I mean, the thing is, if the homework's done properly, and really what you start to look at, then loss is not loss until you give up. Loss is really volatility on a pathway to get there. Warren Buffett has had 3 drawdowns at 50% each in his career.
Yeah, people don't talk about that. Think about that. It's never mentioned on CNBC ever.
No one cares.
Yeah.
And so when you ask them, or when you hear, say, Charlie Munger talk about that level of loss, he's very adamant about it and say, well, this is what it takes to have above average rate of returns. If you want mediocre returns with less volatility, go somewhere else. And I feel exactly the same way.
Katie, let me go one last thing I want to go into. I think it's really interesting the way you state it. I'm paraphrasing or exactly quoting from you. You can correct me if I'm wrong. Only about 12% of the days in a calendar year actually contribute to the major trend.
That's pretty much, I think that's kind of like an 80-20 rule, but when we did this research on it, and I think if you would do the research again, we looked at all types of markets. I wanted to know how much of the calendar days contributed to the net vertical movement of a price trend from one at the beginning of the year to the end. And I was just shocked that no matter what you looked at, no matter what year you looked at, on average, the minority of the trades contribute to that vertical price direction. And then the rest of the time, 88% of the time, or let's just say the vast majority of the time, the market is either moving in the opposite direction or going sideways. So when I came up in the industry, reading about these guys that were managing big money, and there were a few other guys that were getting well known besides John Henry or Dunn Capital. But one of the things that was kind of an accepted premise coming up that I saw, and this was proved to be correct during these huge trends in the 70s and 80s, is that you want to be in the market all the time, and the premise was that you can't catch a wave unless you're in the ocean. I believe that in the early days, but when I realized that that strategy comes with a great deal of risk, because really what you're saying is, I want to be in the market all the time, but 88% of the time, the market is generating non-productive price movement to me and ultimately contributing to my risk. So I started looking at how you design a strategy to where you could contribute in more of the 12% or the vertical movement days and not participate so much in the other part of the market days, which is, it kind of implies that you've got some sort of crystal ball, which I don't. The only thing you can quantify or predict about the future is how much you're going to lose in a given trade. You can't predict the future about profitability or anything like that. I just took the opposite effect, or the opposite point of view, and instead of saying I have to be in the market or I'm going to miss a wave, which worked great in the 70s and 80s, because they were just these unbelievably, and it kind of stopped in about midway in the 90s. They just kept going. The trends were really good. As the industry kind of matured, I got to the point where I would say if I was going to design a strategy, prove to me why I should be in the market at all. Because at any given point, 88% of my trend direction is going to be counterproductive. So I took a different approach, and the strategy that I first designed with that premise, we began trading in 2000. And if you added up all of the days that you could be in the market and all the markets that you have in your portfolio, and you tested that, the strategy seemed to be in the market about 50% of the time. And then I designed a second strategy or program that started trading in 2003. It was in the market even less. It's in the market about 25% of the time. And so what that means is that when you are in, it's more efficient. It's things are happening. Hopefully, if you're on the right side, you have trends, they're happening to the good. But, to be only in the market 25% of the time and still, yes, what you're giving up is that you might miss some movement. You might miss a wave. But at the same time, from a risk-adjusted standpoint, it seemed to be a better approach or a different approach than what a lot of the people were doing, coming up prior to that.
KD, you have been very kind to give me a lot of your time tonight. I appreciate it.
Well, you've asked some good questions, Michael. It's been good talking with you.
I have a feeling I could probably go back and pick your mind for many hours here. I have no doubt about it. And hopefully we can maybe do a second conversation this year, maybe later on in the year, maybe kind of do a break some trading down even more. I think we could just go on.
When the book comes out, you want to do another interview when it does? Absolutely.
We can chat for sure.
That's good because this is something I'm very passionate about. And so I'm very fortunate to be in a position where I can make money with my passion. I don't have any problem at all talking about it.
Where can we, sir, today, tonight, whatever time zone everyone is in, and this is going to go on for perpetuity, where can we send people? Where's the best website we can send people to check you out, check more information about your firm?
Oh, God.
No, there's got to be one main one. What's the main one? What's the back daddy? What's the most important?
Now you're talking about marketing and stuff,
if there's no
I am the when a client calls me, my first premise is this guy isn't going to want to be in this thing. So I'm just, you don't want people to call you. That's fine too. I've actually had people say that. Here is the thing is that most people, and this is a bigger part of what I deal with today, other than, research ideas and that kind of thing. It's a big part because to me, at this point in time, I look at my biggest risks in my business risks that I have. My biggest business risks have to do not with my strategy or the markets, but two other things that I never thought would be when I first started. And that is that where do I house my cash I know it's going to be there tomorrow. I never thought I'd live to that. But where we house our cash is kind of important in today's world, as no matter if you're a manager or not. And the other thing is my real greatest risk is who I allow to come into my business as a client. I've always had a saying: if you want to run a circus, let the clowns come in. And I don't mean that in a demeaning way. I'm just saying is that you want clients that understand what must be done in order to hopefully give them the benefits of what our work can give them. And that means that when you go down into a losing period, or what I call downside volatility, not necessarily, I don't view it as loss. I see it as a pathway to, hopefully a productive end game at the end. But you don't want people that lose faith in that, or that, gosh, I don't know. And the problem you do is that if you have a good year, this is the other kind of people don't think about. You have a good year, you get publicity. Well, if you had a good year, you're probably at new highs. So then the phone starts to ring. People get excited about what you're doing, and they want to start filling out forms to come in, and they're really coming in. If you believe in buying low and selling high, they're really coming in at a time when you're probably at the upper standard deviation of performance, and your odds are you're going to start going back to at least to the mean average. So they come in, and within 5 or 6 months or so, we're down into a zone less than where they came in at, and they kind of start wondering, well, did I do the right thing? So this is not just true within my publicity, but any manager that gets hot, this is what happens. And so you run the risk of taking people in at a time when there's probably some adversity closer nearer than far away, and it's kind of a perverted cycle if you're not aware of it. And I think at some point when I was young, I just wanted to get known. Now I'm very aware that when you have good trading years, that you're probably going to be you're probably attracting people at exactly the wrong time in terms of and of course do you want to attract people when you're in a drawdown? Well, the other side of that coin is that the smarter people will come in then because they know that the odds are that you're going to start going back to the mean average and maybe to new highs. I have some smart people that do that, but that's harder to do than buying a new high, as you well know. I'd rather people would rather buy a stock when it's hitting ultimate new highs and it's going up rather than it's 30% off the highs after 2 years of going nowhere. So it's true with managers as well. So I want to address that because the client part of my business to me at this point in time is probably my greatest risk. I want good clients that understand this business.
I think if I go back to memory, I think what Bill Dunn told me in 1996 when I first met him was we would take one call from a client and the second call they would send the money back. I think that was their rule. I'm not sure if that's exact. Maybe it was maybe the first call they sent the money back, but it was something pretty rigid.
There's a lot of conditioning that has to go on to make sure when a client calls me, it's more like what you would do in getting to know a woman for a lifetime of marriage. It really is that. It's actually more, in some ways, more important, especially if a relationship in this business can last for a long time, is that you really want to know what they're all about. What's their, because here's the thing. If I'm on a 3-year cycle from up to down, let's say, or 2 or 3 year cycle, it doesn't have to be 3, it could be a year, but from peak to valley to peak, it can run anywhere because of the long-term nature of what I do. It could run anywhere from 1 to 3 years. Well, when they make the decision to do what they want to do, they're not thinking about that. So when they come in, they have to have a long-term horizon in order for you to get through the noise of the next 1 to 2 to 3 years. So then when they come out in year 4 and 5, they feel like that they've been smart in making that decision. And listen, there's no guarantee that we make money. But when you've been in the business and stick to it long enough, you begin to believe more in that time will prove to be correct rather than the other way around.
There's something to it. For those doubting Thomases out there, they've just not done enough homework. Okay, you have to either give me a URL or not give me a URL.
Well, my belief is that you cannot sell this business from a website.
Okay, so that means there's no website we're sending people on this.
There is
particular.
My website is and I just recently put it up. I haven't had a website for quite a while, but I recently put one up because people want to. If you don't have a website, then at this point in time, you look kind of odd if you don't. But I have a website for my asset management company. It's anglecm.com. We don't have a lot of information on there, but it's a calling card that people want to find me. They can find me through that website. Okay. But I believe that to load up a website with all this information that is going to give somebody an idea of what you're doing, I'll be happy to provide that to them. But the website, in terms of information, is fairly sparse by design. So people should be aware of that when they go there, because I just don't feel like people are going to make the decision from reading. They'll make the decision from reading all the disclosure information. I can bury them. If somebody asks me for information, I can give them more information than they will ever want to read.
KD, we will talk again upon the book release. I thank you for joining me tonight.
Thank you, Michael.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times.
To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.